Hi, today our group will present the problem scenario. My name is Nurfatihariana binti Ismail. My matric number is 01 DKB50063 and I will be starting with the introduction. Firstly, I will explain about the purpose of credit analysis. This is to determine if a company can repay loan on time and also help the bank assess financial health, business performance, and risk before approving financing. The tool that our group uses is financial ratio analysis. This is to evaluate company performance through financial statement. The company that our group chose to analyze is OCB Berhad that listed under consumer product and service on Bursa Malaysia. This company engaged in food manufacturing, bedding product, and building material. Diversification of business help reduce risk by not depending on a single product line. The objective of this analysis is to evaluate OCB Berhad financial strength and creditworthiness, and also to make comparison over 2 years to see performance, improvement, and decline.
OCB Berhad started in 1959 as HAO Corner and Co, focusing on electronics and telecom engineering. In 1992, it went public, and by 1999, it rebranded its current name. Since 2000, OCB shifted to fast-moving consumer goods, acquiring brands in food, mattress, and property. Today, OCB Group is a key player in instant noodles, mattress, manufacturing, and property development, involving from tech goods to everyday essentials.
Hi, my name is Nur Ashna Jabin Emanashi. My matric number is 01 DKB23F1014. Current ratio for OCB Berhad for 2024 is 1.64, higher than 2023, which is 2.41. So it's certified. Next, we can see the difference between quick ratio 2023 and 2024. The difference is 0.44 is show that quick ratio for 2024 is satisfied rather than 2023. We move on to inventory turnover for OCB Berhad. Here we can see 2024 is lower than 2023, which is 5.53. It means the inventory of turnover for 2024 is unsatisfied. After the calculation of debtor turnover, the formula showed net sale times average trade receivable. Then we get 5.23 for 2023 and 6.25 for 2024. It shows it's certified for debtor turnover. Next, we move on to creditor turnover for OCB. We can see in 2023, creditor turnover ratio is 9.08, lower than 2024, which is 10.84. This also shows satisfied. For profitability ratio, we can see gross profit margin for OCB in 2024 is higher than 2023, which is 23.18%. Meanwhile, 2023 just 21.24%. It showed that in 2024, the sale is satisfied. Next, in the net profit margin, it is unsatisfied because in 2024, it's 1.18% lower than 2003, which is it's 3.70%. Return on equity, it showed the return on equity for OCB Berhad is not satisfied because of in 2024 just 3.2% rather than 2023, which is 4.79%. The second last, we can see the leverage ratio, which is debt to equity ratio. Debt times equity in 2024 is 0.17 rather than 2023, which is 0.25. It shows that it's satisfied for OCB Berhad. Finally, we're looking to market value ratio, earning per share. For OCB Berhad 2024 is 5 ringgit 61 cent only. Meanwhile, in 2023, 8 ringgit 29 cent. It is not certified for OCB Berhad.
Assalamualaikum warahmatullahi wabarakatuh. Now I will be presenting about financial ratio analysis of OCB Berhad, covering 5 main categories, which are liquidity, efficiency, profitability, leverage, and market value ratios. First, the liquidity ratios. The increase in both current and quick ratios show that the OCB Berhad's liquidity position has improved. This means the company now has a stronger ability to meet its short-term obligation using its current assets. It is also reflects good cash management and a lower short-term financial risk. Next, the efficiency ratios. Although the overall efficiency ratio decreased, both the debtors and creditors turnover ratios has improved. This shows that the company is collecting debts faster and paying its suppliers more efficiently. In short, OCB Berhad has managed its working capital better compared to the previous year. Moving on to the profitability ratios. There is some improvement in overall profitability, which indicates better control of operating expenses. However, the decline in both net profit margin and return on equity shows that the company's ability to generate profit and provide returns to shareholders has weakened. This might be due to higher cost of goods sold, increased administrative expenses, or lower sales growth in 2024. For the leverage ratio, the company has reduced its dependence on external borrowing, which means it faces lower financial risk. This is a good sign for lenders because it shows a stronger equity position and better capacity to handle potential losses. Lastly, the market value ratio. The drop in earnings per share, or EPS, indicates that the profitability per share has decreased. In other words, shareholders are earning less compared to the previous year, likely due to the fall in net profit margin. In conclusion, although OCB Berhad has shown improvement in liquidity and working capital management, the decline in profitability and earnings per share highlights the need to enhance cost control and boost sales performance in the upcoming year. Thank you.
Let's take a closer look at the key business risks currently facing OCB Berhad and how they are affecting operational financial performance. First, we have consumer demand volatility. With a moderate to high exposure, this is reflected in slower inventory turnover, suggesting that demand patterns are fluctuating and affecting sales cycles. Next, margin compression is rated moderate. Despite gains in gross margin, net margin and earnings per share are declining, pointing to rising costs or pricing pressure downstream. Competitive pressure also shows moderate exposure. A drop in return on equity hints at strategic challenges, possibly from aggressive competitors or market saturation. On the operational side, efficiency risks moderate as well. Delays in supplier payments could not escalate if not managed, potentially disrupting the supply chain. Regulatory risks remain moderate, especially in sectors like food and liquidity management. Compliance and sector-specific regulation need close monitoring. Finally, financial resilience is a bright spot with low exposure. Strong liquidity and reduced debt have helped stabilize the company's financial footing.